Hi, this is Randy Finney with Right Side of the Chart, and today is Thursday, March 22nd, 2018. In this video, I wanted to go over the sectors within the S&P 500. From time to time, I like to do video coverage going through. There are 11 sectors within the S&P 500, and the S&P 500, for those of you not familiar or haven't really followed my analysis, when I refer to the broad market, that's what I'm referring to, because it is probably the most diversified index out there, encompassing most of the major sectors of the U.S. economy. Whereas you take QQQ, for example, you guys have probably heard me in the past. I often jokingly refer to QQQ as a tech ETF with an Amazon kicker because the vast majority, over 50% of the holdings are technology. You don't have any financials. You're lacking other sectors in there. So it's a lot of tech, biotech, high growth companies, and great during a bull market. As long as things are doing well. But again, not as diversified. And so if you want to get an idea on where the market's going and the economy, then you take a look at the S&P 500 because there are a lot of tells, if you will, from with how certain sectors in certain other asset classes are acting. We're starting here with TLT now. Of course, this is not a sector of the. It's not even. It's a different asset class altogether. Stocks are one asset class. So when we talk about the stock market, S&P 500, every single component in there is a stock. That's equity, ownership in a company. Bonds are another asset class, and I'm going over this because this is what I noticed today, and this is what prompted me to put on XLP as a trade idea. I'm seeing is that, as I spoke about before, we would probably see a flight to safety. A few weeks back when I was looking for the markets to go on, make another high or another thrust up after that low we put in February, and then followed by another leg down, that would mesh with flight to safety. You see that today. We were up about 1%, which is a pretty decent move in TLT, and this is what they call a flight to safety bid. And what I mean by that is institutions, as well as some individual investors, but usually the institutions, when there's volatility in the markets, they have to pull money out to reduce their risk exposure. They have to pull out of stocks, and bonds, government bonds in particular, are the safest place to put that. So you tend to see bonds catch a bid. They call it a flight to safety bid. And so there it is. And that was one thing that I noticed. Then as we go through the sectors, and here they are. These are the 11 sectors of the S&P 500. I just use the tracking ETFs. These are the spiders, which is the same. They're owned by S&P, Dow Jones S&P. So that's the same company. So therefore, I use these ETFs. All the start with the letter X, and we'll just go down. No particular order. Usually, you'll note somewhere on the chart. I usually put what the weighting is. This changes from time to time. I haven't updated the weightings in a few months, but it wouldn't be much different. Give or take a, half a percent a point, maybe a percentage point. So the utilities are not a very large, they don't have a huge impact on the S&P because they're only about a 3% weighting. However, this is, I should say, one of the king of the defensive issue sectors. What I mean by that, what's a defensive issue? Well, as the name implies, when the economy takes a downturn, if we're in a recession, an economic contraction, um, you're not going to go out and eat at a, fancy restaurant as much. You might not buy that second car or second home. Those are consumer discretionary income. Things go down. You don't have that extra income. But what you do, continue to do, the last thing you're going to cut back on, you're not going to stop paying your electric bill, your water bill, your heating bill, etc. Therefore, utilities, they're not affected, at least their bottom line, nearly as much by a downturn in the economy. So what happens, particularly towards, as the institutions see maybe the economy may be slowing down, they start to move into that. So you can see here clearly from the lows here in early February, there has been a steady inflow, and I don't know if you can make out the volume bars. There's been a big increase in volume too. This isn't just a dead cat bounce so far. I started getting bullish back here on utilities. They made another low, but I maintained my bullish bias on these. You're not going to get rich quick off utilities, but I'm doing this video because I know there are a lot of investors and traders out there that don't short stocks, whether they think it's anti-American. I've heard all kinds of excuses, whether they're just not comfortable, whether they don't have the ability, the skill set, they don't understand shorting. What you can do to mitigate your losses during a bear market or a market correction is at least move money either into cash. That's always a very viable option, or into defensive sectors. So anybody in utilities for the last few months would have made money. As you can see, XLU going up and up again today, about 0.5%, with the market taking it on the chin. You know, the Nasdaq 100 was down 2.5%, and so was the S&P 500. So uh, that is a huge disparity. We call that relative outperformance or straight up outperformance. Even if the XLU was down by 0.5%, it would have still been relative outperformance. But so there it is. I just wanted to point that out. So when I noticed Treasuries were up, XLU was up, as I would expect on a day like today. But what's more interesting is we saw a big sell-off out of these, a big move out of the defensive issues. Really heading in, from the end of the 2017 into early 20, into early 2018, and I think a good part of that is probably over. Another way for me to phrase this, I think the downside on a lot of these defensive issues, namely XLU and XLP, which we'll get to in a second, the consumer discretion staples, I think the downside is minimal. So when you hear me talk about the term relative performance, and I use that in the XLP trade today, that doesn't mean XLP can't go down. It just means that if the NASDAQ 100, let's say, drops 20% from where we are today, I would expect XLP to, at most, at best, or worst case scenario, I should say, excuse me, at worst case scenario, drop a lot less, maybe 5, maybe 10%. And that's still relative outperformance. In other words, in that case, it would lose less than half of what XL or what QQQ or even SPY might lose. So those are terms used in investing and trading. And I'm sorry if I'm making this confusing. I'm trying to throw a lot out there. Next up, and again, not in any particular order, this is real estate. Now, the REITs are relatively small, about a 3% weighting, and they also took it down took it on the chin. But you've seen a bounce back into the REITs. I also like to use IYR because that's a REIT ETF that's been around a little longer than XLRE, which is the Spiders REIT ETF. But either way, that one's not doing so hot lately. This one's not so much a defensive issue. Now, there's all types of REITs. I don't want to get off topic here. You have, hospital REITs, shopping malls, apartments. So there's many different types. Some do better than others in different economic environments. But I don't want to get off topic. I don't have a strong opinion here on XLRE, but just want to show you the chart that it has, like XLU, rallied after a big correction, and there's some support right here. You can see there. Not one of my favorites, so I'll move on. Now here's XLP. I'm doing this video for members only, premium content as I'm going over individual sectors. So I'll share this XLP trade idea. As you can see on the chart here, these arrows circled, that shows you the reactions. In other words, this is what defines that support level that we fall into. You have a reaction here. Prices fell and bounced. They came down again and bounced. Once that level was broken, we back tested it and failed. So these are all reactions. We regained it, tested it, and it held. The more reactions you have off a certain price level, the more significant that support level is. And what we have now is we have XLP. Again, this is the consumer staples ETF. Consumer staples are products that you need. The Procter and Gamble. I'll go over a few names in a second. That'll kind of give you guys, if you're not familiar with what consumer staples are. But those are the things, the staples that you need. Even during a recession, you're going to continue to buy those items: milk, eggs, razor blades. Personal hygiene products, stuff like that. That you're not going to cut back on that spending when times get tough, like you might on your fancy NFL package on your cable or satellite. All right, so this is, and you can see on the chart, this chart I've shared many times in the past. You can see it's wash, rinse, repeat. Like I often say, you have a negative divergence, big divergent high, you followed by a correction. That you came full circle here. You had positive divergence on the indicators, momentum indicators down below, and that was followed by a nice rally. At the highs, you had negative divergence. And again, this was pointed out back then, and that negative divergence, as so often is the case, is followed by a trend change, a pretty big correction. In fact, this is one of the biggest drops that we've had in years, especially in such short order. You can see, what is that, about a 12, almost 13% drop in the staples since the end of January, really. So yeah, January 30th. So a heck of a correction. What does that mean? Well, we're oversold. What does oversold mean? It's not a buy signal in itself, but it does start quickly shifting the odds in the favor of a bounce happening. Let's see, we're oversold right here at this point when we tag this level, and look at that, we had a huge rally. Didn't last very long, but percentage gains, it was a quick trade. We were oversold right here, you can see, and we had a huge rally. So again, it's pretty simple stuff, guys. I look for these oversold readings. I look for divergences. I like to see oversold and a divergent low. So in other words, this was the first oversold reading in 2017 right here, and you had that little rally. We went down, made another low. We made another lower low. It was also a divergent low, positive divergence. Boom. This is where you get long for swing trades. This is where the big trades are made. You can get the smaller trades off those one and done tags of the oversold level. But again, here, oversold right here, you had a little pop, and then you came oversold again with positive divergence, and boom, the big rally. All right, so that's my trading style. I will at times go long off these just if something's oversold at support, but I get even more excited when it's oversold at support, as we are here, as I just showed you, with bullish divergence in place. Now I have to put a caveat in there. I referred to this as potential positive divergence. Why potential? Because this indicator, the PPO primarily, is still pointing down. Both lines are pointing lower. That means we have the potential to take out these divergences. If XLP slices right on through here and keeps going, and goes much lower, we will no longer have positive divergence on this indicator on the PPO. It will be confirmed, at least in my book, when the two lines cross, the signal line or the PPO line crosses back above the signal line, thereby putting in a equal or higher low on that indicator. You can see the RSI has a little room too. And so that's that. So like anything else, this trade will either play out or not, but I'm trying to share ideas, both long trade ideas for those that are looking for longs, or at least a way to diversify their portfolio. And then when we zoom down to the 60-minute chart, this is what I'm looking at here. As I mentioned today in the trading room, I don't know if you were able, maybe you're a silver member and you weren't in the trading room. I mentioned that we parked the indexes. They parked the indexes right on support. Yeah, I had that target on QQQ around 163, and give or take within a fraction of percentage point, that's where we closed today. So we could bounce tomorrow. That's my expectation, although anything's possible. If we do bounce, what we'll do is we'll take out this 60-minute downtrend line, and there's a first target. So again, not a lot of meat on the bone for this trade, a little less than 3% at that if that first target is hit, and if that second target's hit, that's about 6%. But again, just a way to add some diversity to your portfolio. And some people, particularly if you don't trade on the short side and the market's having a tough time, you might be happy to make 3% or 6%. It's a lot better than losing money. So that's my thought process there. And as always, if you like a trade, take it. If you don't like it, pass. My job is not to tell you what to buy or sell. It's to just share the trade ideas that I see, the best looking trade ideas, and then identify objective entries, targets, stop levels, and let you guys decide what to take, where to sell it, where to buy it, and or whether to just discard it and move on to the next one. XLT telecom, again, not a huge sector, about a 2% weighting, so I'm not going to talk on it too much. Most importantly, the telecom sector has been grinding in a awful, horrible sideways trading range now for since late 2016. So for quite a while, we had two brief dips below that level, right here and right here. That yellow line is not a price line. That was just a measured target if that basing pattern breaks down. So other than these two little whipsaw false breakdowns right here and here, that yellow box shows you that sideways trading range. This market also looks very toppy. I look at a lot of sectors and they're just going nowhere. It's very indicative of a market that is running out of gas. Tech has been making new highs until recently, but a lot of other sectors are really stalling out. So what I'm trying to paint here is the big picture, not just the NASDAQ 100, because there's a lot more to the U.S. economy and the U.S. stock market than just technology. XLY. Consumer discretionary chart doesn't look so hot. It was extremely overbought. Discretionary, of course, meaning these are items that if you have discretionary income, you go out and buy that. You know, Rolex would be in here, for example. I'm not even sure. I don't think Rolex is a publicly traded company. If it is, it might be in here. XLE, energy sector. We have a long, and I've done several updates recently. We fell just shy, so close to my second and final target right after we put this trade on that effectively the target was hit. Now, it wasn't officially hit. It just means that I had that target set just a few pennies too high. But as I often say, from my experience, when one of my trades comes within pennies of a price target and reverses, especially on my final target, that's usually it. So I still may close this one out. We certainly haven't stopped out. We're about back to where we started, where we got in the trade. Actually, it's still profitable. We already hit the first target. It's up to you, but if you want to know where I think this one's going, it's probably going to come back down here at about this, I don't know, $64 level, especially if it drops out of this consolidation range that it's been in. So that's XLE. About a 6% weighting in the S&P 500. Here's XLB, basic materials, uptrend line right here. We had a false break here, another breakdown here. It's not looking so hot. I'm not crazy about this chart. I don't have a super strong opinion, and I should have done this with the other ones. When I jump out to a weekly chart, which I've just done here, this is 10 years now. We were looking at the daily charts before. That only goes back 2 years. These weekly charts tell me this market is in trouble. It is starting to crack. There are sectors like this. You can see this trend line here. You can see this red weekly candle that we still have 1 day left. So you can see back here in that sell-off in late January, early February, we had a stick save. What that means is intra-week we went down below the trend line, just like the market did, the S&P 500. I covered that already, and we closed back above it. But like I said, just like the broad market, we keep tapping on support. You tap on it too many times, it's going to break usually. And this one's broken, and I really doubt we're going to close the week back above that. At best, we'd be looking at a back test. So the longer term outlook for the basic materials does not look good, nor does this daily chart. XLV healthcare. Um, this one near term, and I'll have to separate near term to intermediate term, talking, a few days to several weeks, maybe even a couple months. This one looks okay, one of the better looking sectors because we're at support. You can see the line that we're at now. I'll start right here, look at all the reactions from below, and then once we broke above that level, all the reactions from above. So here's a sector that's fallen down to support with potential. Again, not confirmed, but potential positive divergence. Got very overbought at the highs and had a sharp correction. So it's at support. But as I often say, support is support until and unless broken. So if they break the support level, especially a closing basis, we're probably headed down to this next support line I have here. But if the market can manage to bounce here, there may be a trade here. So this is one of what I think is the better looking sectors right now if you want to take a shot at a long in an ETF along with XLP. I think this one could play out. And at the very least, it's objective. If you buy it and you put a stop not too far below that support level, maybe on a closing basis. But if you start to reverse and you see these divergences confirmed, this one could rally, could maybe come up to those highs or possibly more. We'll have to take a look at a weekly chart, still above trend. You had a minor trend line here we broke, but this is a more significant trend line. So healthcare is one of the better looking sectors. XLK technology hanging on by a thread. This is almost a mirror image of QQQ. You can have the same trend line that you have on QQQ, as I often say. QQQ is like a tech fund with an Amazon kicker, meaning you have a big retailer company in there that's one of the big components. But this chart is ugly, guys. Just like the broad market, here it is, a very well-defined uptrend line off the mid-2015 lows, and we had a stick save in that recent correction. Went back to the top of this price channel, but we are right now today we closed on it. So tomorrow is a make or day break for the market. I'm positioned for. I hedged up. I told you guys I took some longs on the Qs. I still have swing shorts. Now you got to separate that. I have positions. If my trading plan is how I'm going to swing this down to this level, those are swing trades. But because I'm leaning towards slightly a bounce tomorrow off the support levels we closed on. I took some long, mostly QQQ related longs to either hedge me or as a pure play. If I get a quick bounce trade, I'll take profits on those, and I'll make a decision before 4 o'clock whether I take any of that long exposure home for the weekend or not. But I wanted to point out. If we have a big red down day tomorrow, close the week red, we've broken trend. Now, that's not the end of the world. There's a 40-week moving exponential moving average. If you can make out this red line here, it does a pretty good job of defining the trend. That's also where we reversed back a few weeks ago, a couple months ago. So there's still some support levels below, but it starts to really get ugly, guys. More and more sectors that break below these trend lines, the greater the chances are that this bull, at least for the time being, is over and there's more downside in the coming weeks to months in the market. XLI, we're still in a weekly time frame here, starting to crack below trend. Again, very well-defined trend line. You can see this candle, the red candle. That means we closed down here today. So this one needs to really giddy up tomorrow, mount a pretty strong rally into the close Friday, or else we're going to print a weekly candlestick close on the industrials below that trend line. The industrials, by the way, is about a 10% or so weighting in the S&P 500. Very near term, again, we do have support right here. It's about 73.18, give or take. If that level goes, you can see my next support level down here, roughly a little bit below 70. And so those are some near-term levels to watch. And finally, the financials. Financials are walking the line. The trend line I'm referring to here is an uptrend line. In fact, this one goes back beyond this 2-year chart, so all the way back here to early 2016. You can see back then, I guess I would have highlighted this inverse head and shoulders bottoming pattern right here. Nice, beautiful inverse head and shoulders. There was your neckline, breakout of the pattern, back test, then off to the races. But forget about that. That's what's happened. That's in the past. Let's look at what's happened since. So we see this trend line from where the head on that pattern formed, the lows back in 2016. That's where that trend line generates off of. Let's go back to this 2-year chart. Remember, it goes to the left there. A lot of reactions. This is a well-defined trend line. So you have the financials now at that level. If I didn't have this big negative divergence leading up to this recent high, I would say this is a great time. You want to, trading 101, buy pullbacks to support. Let's go long here for a multi-month swing trade, just like you could have went long back here, back here, and all along. When I see this divergent high, that tells me it's only a matter of time. Maybe we get a bounce first before this breaks, another rally. Maybe we take out these new highs, maybe not. But ultimately, we break and we don't just drop a few percentage points. I think the financials are probably coming back down. Looks like I had an official trade back here where we hit this first target. That's a pretty good support level right there around $23. You can see T1 hit. I think that's where the financials will be headed within the next few months. Stocks fall a lot faster than they rise. Keep that in mind. If we get there from where we're at today, that's another 17% drop. I know, I'm sure a lot of people out there think that's crazy, but that's where I see it going, whether it happens or not. And before we wrap up, let me just go back to the weekly charts because I didn't cover it on some of those earlier ones. XLU utilities, you can see they held support. They're trendline support. Bigger picture is not good. You can see the big divergence, negative divergences. Now, a lot of those divergences played out. It played out for that big 16% or so drop. But again, we're at trendline support. It hasn't given up yet, so I'm just looking maybe a little more upside. Utilities hang in a little longer, and ultimately they break. XLP, consumer staples. This is the one that we went long again today. You can see it on a weekly chart. So to make very clear, I am near-term bullish, cautiously bullish, let's say, on the consumer staples, but longer-term bearish. Guys, we're looking at the end of a great bull market. It's inevitable. Whether that end has already happened or whether we have another rally and it happens later in 2018, possibly 2019, I doubt it. These are powerful divergences. These are things I saw leading up to the bear market high in 2007. This is a pretty significant trend line. We're already below that trend line. And so, what I do, and it may sound confusing to some at times, you might ask how I can be bearish, bullish on XLP today, but yet bearish longer term. I'll define your time frame. If you're looking out a few days, a few weeks, and you can game a 6% or so rally, and then catch the next leg down, position short, go long here. I can tell you right now, you can see that line very well defined. That if and when XLP gets there, if the charts confirm at the time, most importantly, I won't go long just because I have a line there. I'll look at how prices are acting, what the indicators look like, what the broad market looks like, many other factors. And if it confirms, then we'll have a long entry there. It might be good for 10% or more trade. I love bear markets. I love bear markets because bear market rallies are extremely powerful. They're more powerful than bull market rallies because you have a lot of shorts in there that get squeezed out, they cover. Um, a bear market is like a bull market with the fast forward button hit. The corrections drop, they go down a lot faster, and the bear market rallies are powerful, and I love to trade them. So I'm looking forward to the next bear, whether it's here now or not. Doesn't matter to me because I'm not positioning, XLP. It's not as if I'm shorting right now and I'm going to hold it down all the way down to this level, but before all is said and done, before this bear market's over, and this might be 2019 or 2020, I think we'll probably come down. We could easily come down here to the 39 level, at least that $43 level. But we'll see. A lot has to happen before we get there, and we'll take it one day at a time. Like I always say, it's like weather forecasting. I can, determine with a much higher degree of certainty and probability what's going to happen over the next few days, to few weeks, to even a couple months than I can looking out 6 to 12 months. Same with forecasting weather. It's just a crapshoot the longer you go out in time. But the charts can sort of be your guide to where things might be headed. Let's wrap it up here. Keep this video, we're at 26 minutes. I'll try to keep them a little shorter. I just wanted to cover my thoughts and again give you guys paint a bigger picture of the pieces that the stock market is comprised of in our economy. And I don't see a lot right now. Remember, during a bear market, most sectors, even the defensive sectors, will fall. In a vicious bear market, they just tend to fall less. And cash is always an option, but then we're looking more and more at things like commodities and bonds and other things that can actually flourish during a bear market. So I'll do my best to continue to provide the best looking long and short trades as we go. And as always, if you guys have any questions, just drop me a line. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.